So what's changed in the banking industry in the last few years is primarily the fact that capital is a lot more expensive for banks following the financial crisis, the GFC. And what it means is that essentially regulators have forced banks to think more carefully about where they apply their capital and when the capital is applied to products that are less liquid and where there's more risk. There's a lot of capital cost that's linked to that. And what it's led to less capital being deployed in many of the products in which we transact. And so you'll find that many of our competitors that on paper seem very large don't have the right balance sheet size to compete with us. So that's one large impact of the GFC. The other major change you witness in banking, and we continue to witness in banking increasingly, is at the compensation level. So if you think about banks, they've really been shrinking the staff that's in the middle. I.e., if you look at a bank in the old days, you had a lot of staff who was reasonably experienced, 5 to 15 years, and then a few on top were very experienced. If you think nowadays, you have a lot of managing directors that have been around for a very long time, that are sticking around because they are well paid and they've got high fixed compensation, and then a juniorization of the staff underneath. And what it means is that generally you don't have the hunger, you don't have the ambition, you don't have the appetite or the experience. And if you compare with our staff, the level of experience is significantly greater. Why are sort of the more experienced people that haven't made it to the top, why do they not want to stay in a bank? Because they can be compensated for the growth potential. And so the banks are going to this phenomena of cutting costs and cutting staff. So you have less people and less experienced people. And as a result, our clients are better served with the staff that and the people that are working with us, because they're tremendously more qualified than their peers in larger institutions. The third impact of the GFC, which relates to the first two, is the fact that a lot of clients that aren't the super large clients aren't covered anymore by the banks. Right? So the banks are deploying less capital, having less staff and less experienced staff. So what it means is that banks have to shrink the number of clients they can cover because they can't service smaller or mid-tier clients anymore. Again, that's an opportunity for us because we don't have the same cost base that the banks do, and we can cover those clients and help them succeed, and that's a profitable business for us. It's not a profitable business anymore when you have a very large cost structure and a shrinking balance sheet. So those are the combination of factors that have made traditional banks less competitive, which have opened the door for institutions like ourselves to succeed. And I don't think that process is reversible, because it simply makes sense. It makes sense for regulator to enforce all those rules on bonuses, on capital, because there is too much systemic risk if a large bank fails, which pushes the regulator to need to bail them out. And as a result, you have to minimize the risk that some of those banks are in that position where the taxpayer has to bail them out.